Okay, so now let's talk about adjusting entries. Now, as I mentioned in the preceding video, the purpose of an adjusting entry is to bring an asset or a liability account to its proper and correct balance, while at the same time recognizing a revenue or an expense. You do adjusting entries periodically throughout the accounting cycle, but it's certainly not something you do generally on a day-to-day basis. Now, there are four kinds of adjusting entries: deferred revenues, deferred expenses, accrued revenues, and accrued expenses. And I also want to recap that in addition to trying to bring a asset or liability up to its current and correct balance while recognizing a revenue and expense, another aspect of adjusting entries is that they never involve cash, and they will always involve an income statement account and a balance sheet account. Now, as I said, there are four types of adjusting entry: deferred revenues, deferred expenses, accrued revenues, and accrued expenses. And what distinguishes one from the other is whether or not you are receiving cash or paying cash, and the timing of when you recognize the revenue or the expense. What does that mean? Okay. For deferred revenue, cash is received before the revenue is recognized. So for all of these transactions, I want you to understand there are actually two sets of transactions. There's an initial transaction, and then where we're recognizing some event or some transaction, and then there's a transaction that happens later on down the road. Depending upon the type of adjusting entry, sometimes that first entry is the adjusting entry. I know it sounds weird, but when you're dealing with accruals, the first entry is the adjusting entry. When you're dealing with deferrals, the second entry is the adjusting entry, which kind of makes sense, okay? So anyway, in the case of a deferred revenue, something happens. We receive cash before something else happens, the recognition of the revenue. So a situation like that, a hypothetical would be, I'm a tax accountant. Someone walks in my door on January 1st and they say, Mike, you're a fantastic tax accountant. Here's $1,000. Please do my taxes next year, or this April. Can I recognize that $1,000 that's sitting on my desk as a revenue? No, I cannot, because I'm an accrual-based system and I have not met all four criteria or criterion for recognizing revenue, okay? Principally, I haven't done the work yet, okay? But I still got to put that on my books. So I debit an account, cash for $1,000, and I credit a liability account called unearned revenues. So that's my first journal entry. And then at a later date, say April 15th, when I mail the return to the IRS, I'm going to debit unearned revenues, which is a liability account, for the $1,000, and I'm going to credit revenues for $1,000. I am recognizing my revenue in that second entry. Okay. So let's think about the definition again. Cash received before the revenue is recognized. Cash was received on January 1st. The revenue was recognized on April 15th. Two sets of entries. The second entry was the adjusting entry. How do we know that? Well, it didn't involve cash. It involved a balance sheet account, and it involved an income statement account. Deferred expenses. Cash is paid before expense is recognized. So, the first event, the first transaction, I pay cash for something. The second event, which occurs at a later date, is the recognition of the expense. Now, what is an expense? It is the doling out, parsing out, spreading out in increments of that asset's cost over the life, the useful life of that asset. Not confuse cost with expense. Okay? So hypothetical situation is insurance. It's January 1st. I bought an insurance policy for my warehouse for $12,000 cash. I debit prepaid insurance, which is an asset account. Okay. Technically, it's a prepaid expense, but I call this account prepaid insurance. I debit for $12,000. I credit cash for $12,000. That's the first transaction. Cash is paid. The second transaction is the expensing transaction. That's the adjusting entry. That happens on January 31st, where I spread out a little bit of that cost, $1,000 to be precise, as an expense. So I debit an account called insurance expense for $1,000, and I credit my asset account, the prepaid insurance account, for $1,000. So I brought the net value of that account down. I have recognized an expense, and I have adjusted the asset account to its correct balance. Okay? And again, note, the second entry does not involve cash. It involves a balance sheet account and an income statement account. Therefore, the second account of the second transaction is the adjusting entry. Now, things get a little weird when you go over to the accrual side. For an accrued revenue, cash is received after the revenue is recognized. Okay. So let's think about this. It's January 1st. Someone walks into my store, buys $1,000 worth of computer equipment from me on store credit, and I am an accrual-based business. My first entry on January 1st is to accounts receivable for $1,000, Mr. X for $1,000, and I credit revenues for $1,000. Why? I haven't got cash. That's true, but in accrual-based accounting, revenue recognition is not based on cash receipt or receiving of cash. It's based on, are the four criteria met? And they are. Persuasive evidence of a agreement between the principal parties. The goods have been tendered or services rendered. They've walked out the door with the customer. My fixed, the seller's costs are fixed or reasonably determinable, and there's reasonable likelihood of receiving payment. Revenue earnings process is completed, so I can recognize the revenue. So the first entry for an accrued revenue is recognizing the revenue. The first entry will be, I will debit accounts receivable for $1,000, I will credit revenues for $1,000. Revenues is an income statement account. Accounts receivable is a balance sheet account. The first entry of an accrued revenue is the adjusting entry. I'm bringing to the correct balance an asset account, the accounts receivable account, and I am recognizing the $1,000 revenue. So for an accrual, the first entry is the adjusting entry. It's kind of counterintuitive. The same thinking applies for an accrued expense. Cash is paid after the expense is recognized. So the first transaction, let's say I pay my employees weekly. I pay my employees every Monday, okay, on the basis of their previous work week. I've got one employee, he or she earns $100 a day. So Friday evening, I'm going to debit an account called salaries expense for $500. It's an income statement account, and I'm going to credit an account called salaries payable, which is a balance sheet account. So I am, by debiting salaries expense, I'm recognizing the expense. By crediting salaries payable, I'm bringing to its correct balance a liability. Neither account involves cash. One is an income statement account, the other is a balance sheet account. That first entry is my adjusting entry. I know it's counterintuitive. And then at a later date, Monday, for example, the following Monday, when I actually pay my employees, I debit salaries payable for $500, and I credit cash for $500. Well, both of those are balance sheet accounts, and one of them is cash. That second entry cannot be an adjusting entry. So this takes a little studying